Well, what should we do? Obviously, we need alternative renewable energy sources. We need solar and wind, for example, but these are different kinds of energy sources. They're intermittent. They're not dispatchable on demand like coal and natural gas and oil. So it means we're going to have a different kind of energy future. Transportation almost all runs on oil, and there are only partial substitutes. Yes, we could have electric cars, but automobiles are inherently energy inefficient. Can we have electric airliners? No, the batteries would be way too heavy. So the whole airline industry is problematic going forward as we transition to alternative energy sources. We have to rethink not just where we're getting energy from, but how we're using it. In transportation, we need to be looking not just at different ways of fueling our cars, we have to look to alternatives to the automobile. We're facing a less mobile society. So how can we organize our lives and our dwelling patterns so that we can do what we need to do, whether it's working or shopping or growing food or whatever, while traveling less, using less motorized transport and more walking and bicycling. We need to make our buildings far more energy efficient, and certainly that's possible in Germany. There's been the passive house movement. Over 20,000 commercial and residential buildings have been constructed that use almost no input energy. And that's just by sealing up the building envelope, increasing insulation, and then providing ways for sunlight to heat the building and for solar collectors to heat water and provide electricity. Well, if that can be done in Germany, which is a relatively cold country, why can't it be done more in North America? I inquired today and learned that there have been only a couple of passive houses built in Canada and maybe a dozen or so in the US. So building retrofitting and changing building standards is an area where enormous strides can be made. Then the food system. We've built a food system around oil and natural gas. Natural gas with which to make ammonia-based fertilizer, and oil to fuel transports to the farm, to fuel farm machinery, and then to transport outputs from the farm ultimately to the consumer's plate. Something like 7 calories of fossil fuel energy go into growing and transporting every calorie of food ultimately to the consumer plate. That's a food system that's almost designed to fail under the circumstances that we've been discussing.
First, thanks very much for your talk. It was very enlightening. And I was intrigued with your example of your story about Chesapeake and how they made their money by selling leases. That's essentially how they are profitable on a net basis. But I'm wondering, these projections that you're putting out there around natural gas production levels declining significantly much sooner than, let's say, the industry's projecting, they're going to make their investment decisions based on looking at what the potential downside is. Like, these are smart people that are projecting forward. And so I'm just seeing that in British Columbia, there's several major companies making multi-billion-dollar investment decisions so in assets like pipelines and LNG processing facilities. How do they make these decisions with the potential downside that you're showing there, like with production volumes not being anywhere near what?
The people who are making those infrastructure decisions desperately need the information from our report, and we've made it as readily available as we can. If you go to shalebubble.org. You can download a PDF of our 140-page report on shale gas and tight oil. It's called Drill Baby Drill, for obvious reasons, because it's a drilling treadmill that's involved in these production operations. And the information is clear, and the analysis is transparent, and it is increasingly being discussed in the mainstream, but it's still considered, sort of outlier. Okay, you have all of these people, the IEA, the EIA, and the industry forecasting, abundance and cheap shale gas for as far as the eye can see, and these guys over here, a few petroleum geologists and this nonprofit think tank in California, raising the alarm. Who are you going to believe? But I have to say on our behalf, this is the most robust analysis that has been undertaken to date of shale gas and tight oil well productivity. We've looked, and we have not seen anything equivalent from U.S. Department of Energy, from the International Energy Agency, or from any of the industry-supported energy analytic companies. So we totally stand behind our data and analysis, and the data is industry data. So that's to be taken for granted.
Just following along that line of thought, is there some sense that if industry were to accept this data, accept this analysis, and start putting that into their messaging, their stock price would plummet?
Yeah, and we are unquestionably going to see capital fleeing from these companies over the next few years. When exactly the bubble will burst, I can't tell you, but it is a bubble. And it's all based on perception. As all bubbles are, it's based on perception. So as soon as the perception changes from profitability and abundance to, okay, the party's over, then investors are going to flee. All of these companies are highly leveraged. It takes a lot of money to drill. We're talking about low energy profit ratios and pretty low operations profit ratios, especially for dry gas. In those cases, as we've said, they're actually losing money on production. So as soon as investors begin to understand these things, I think we're going to see a lot of people fleeing toward the exits.
You said it's a pretty depressing subject, and it is, but your talk almost seemed a little optimistic in that, is it right to conclude from what you were showing that oil and natural gas companies will actually sort of run themselves out of business in the next 20 years, and that maybe renewables would catch up in price even without carbon taxes helping us along? Is that like a reasonable conclusion?
In some ways, this is good for alternative energy if the investment capital is there for them. So far what we're doing is throwing more and more investment capital at resources that are showing ever declining quality and profitability. That's a path to perdition. But one of the problems with that is that there isn't infinite investment capital out there to fund energy projects. And if most of it, the vast majority of it, is going to fund these marginal, unconventional oil and gas projects in the belief that this is our future, in the belief that there's 100 years of product there, then that means there's less available for the renewable energy industry. This gets to government policy. We've had in the U.S. President Obama go before the country in his most recent State of the Union address and basically parrot the industry line about the abundance of these fuels and the profitability and the benefits in terms of tax revenues and jobs and so forth. As long as that's the case, as long as we have this all of the above energy policy, then the benefit to the truly alternative energy sources, solar and wind and so on, is pretty muted. So what happens then when we get to the crisis point where the fossil fuel companies start to fall by the wayside? Well, then that may have pretty dramatic economic impact on the rest of society, which in turn might cause investment capital to dry up even further. This is what happened in 2008, remember? So yes, there's the possibility of an upside there, but there's no guarantee. And the more we can direct policy toward support of renewables prior to the crunch, the more insulated we will be from the worst case scenarios there.